Hi, everyone. I'm Michael Henley, the CEO and founder of Brandywine Private Wealth. I am joined by Peter Kim, our Chief Investment Officer, to talk about, the general trends in the market. What a crazy 2025. So starting the year off, Peter, very optimistic on the potential deregulation coming to the tariff tantrum we had in April that was kind of a mess. The trade deals and the market kind of remaining, very resilient globally. It was a banner year for pretty much every asset class, it seems. Talk to us about what were the surprises last year? What did you think?
It was just a crazy year in terms of everything we saw, right? You saw this giant arc up and then a big crash down and then fully recovered and then posted positive for the years in terms of positive numbers for pretty much everyone.
And we were almost down on bear market, right? Down almost 20%.
20%. If you did intraday, we're down 20%. If you did at day's closing or close, like 19.5%.
Okay.
Yeah, pretty much. That's a full swing of the market and then fully recovered, posting positive numbers pretty much across every metric. Good to see.
It's almost a 40% swing, down 20, up 20,
Yeah,
more or less.
that's a good way to think of it, yeah.
Okay, got it. So what's the latest news out of the U.S. markets?
It's a bit surprising, right? U.S. markets did extremely well. Everyone was expecting some weakness. I think volatility obviously came.
Yep.
But by and large, going into 2026, economy is on really good footing. You're seeing more and more activity on the M&A side. You're seeing more and more companies continuing to spend money.
Okay.
Consumers are still spending money. That's all really positive for the economy, and it should be positive for the markets by and large going forward.
Okay. Is this really telling us that basically U.S. companies are incredibly nimble and able to navigate tariffs? Because the effective tariff rate was 2% a year ago. Now it's like 12% or something.
Yeah, it shows how much resiliency there is in these companies and how quickly they can adapt. I think people used to think of them as very slow, meandering beasts. And now, when you think about the last 5 years, you had COVID, so you had a global shutdown of economies. That was supply side driven, right? Then you had this boom in everyone working from home and everything kind of switching over to that and kind of an online structure.
Yep.
Then everyone's working back now in offices.
Yep.
And companies had to go adjust for that. You had tariffs come in place. You had interest rates spike on us.
That's right. Okay.
All of these things kind of impacted companies, and corporations have had to deal with it, and they're really good at dealing with it now.
And corporate profits are still improving, right, overall?
They're at least maintaining where they are, depending on where you look at. But yeah, by and large, revenues are still pretty good. Profit margins are still pretty good. They're certainly getting a little compressed because they're eating some of the tariff impact, but by and large, still very good.
And last year, were we led by 7 stocks again, or more of a broad rally?
It's a good thing you mentioned that, right? Magnificent 7, not as magnificent last year.
Okay.
Not doing as well. You saw kind of a broadening out. I think a lot of it is still probably AI related, and it's other industries that are, I'll call it AI ancillary related,
Okay.
are getting kind of the impact of it now. And
So more than just NVIDIA is a beneficiary of AI, is what you're saying?
absolutely.
Okay. Got it. Okay. That's great. How about international market? What's going on overseas?
They carried the load for us last year. It's glad that we have global portfolios because international markets did really, really well.
Yep.
It's good to see. I think there was kind of a less uncertain road for the international markets, and they had just such a lower starting point that it made a good value play for a lot of people. Going forward, they're still in a good spot.
Okay.
Countries are still spending money. They're expanding their balance sheets. Everyone wants to be involved in the AI boom and not left out of the tech boom that occurred in the early 2000s like Europe did.
Yep.
So everyone is trying to capture this. Everyone's spending more money on defense now. So that should be very good for general markets.
Okay. Outstanding. So international momentum may continue. What's the latest from the Federal Reserve around interest rates? Cuts this year, I take it?
I would assume we'll get some cuts this year, right? With Chairman Powell stepping down or leaving his term in May. At some point, yeah, you would assume the administration is going to put someone in that has kind of a more aligned sense of their view of the world. Probably a cut in March, maybe 1-2 more with the new Fed chairman at the end of the day. But yeah, interest rates are still coming down.
Okay, got it. What changes have occurred in our portfolio models as of late?
It's a good thing to see. Thankfully, we've already done a lot of strategic work. So we've expanded our models. We've increased the equity exposure. We're now fully invested kind of across all of our model allocations. And it's nice to know that we don't have to make these rash tactical decisions because we've already done the work and let the models kind of expand as the market expanded, and we're managing risk on the fixed income side to help manage some of that volatility for everyone.
Okay, so then in way of rebalancing, you're just kind of selling the winners, buying the losers. I guess we're trimming gold up 60% last year, buying broad equities.
Yep.
Okay.
Absolutely. It's a good way to dollar cost average if you think about it in a micro way, right? You're selling the relative winners, buying the relative losers.
Yep.
And kind of balancing.
So you're not market timing, but you're selling the winners, buying the losers. Just
Exactly.
capturing price.
Exactly.
Makes sense. It seemed like the only asset class that was down last year was Bitcoin. For any clients who do follow this, any thoughts there?
It happens.
It's a volatile asset class.
It's a volatile asset. It's been up for the last 3 years by record numbers. So you would expect there to be some sort of retrenchment and breathing room there.
Okay.
I think going forward, there's certainly more tailwinds than headwinds pushing it going forward for us at this point though with it.
Got it. Like always, Peter, we like to talk about the 8 laws of investing. We're going to talk about law number 2 today, which is basically that most investing mistakes happen from trying to run a marathon in an hour. So what does that mean as it relates to investing?
Absolutely. People always like to look at investments kind of the short-term view of how am I doing for this day? Is market up? Am I up? Is market up for the last year? Should I be up as much as it? But in reality, your timeline is honestly for the rest of your life, or potentially if you're legacy planning the rest of your life and potentially your kids' lives at that point.
Yep.
So it's not really what did I do in the last month or last year? It's what am I doing for the last 30 years or what I'm going to do for the next 30 years of my life?
Got it.
Making sure your investments and your expectations are kind of timing along with that, right? We're not really concerned about day-to-day volatility because there's no way to control what can happen in the markets in that short of a time period. But if you believe in the markets and that they're able to go up over time, you just want to be involved in it, and that patience will
pan out. Okay, makes a lot of sense. So basically, ignoring the noise in the short term, stay focused on the long term, stay diversified, stay disciplined. Okay, got it.
So,
makes a lot of sense. Well, thanks everyone for joining today. Really appreciate your time. And if you have any questions, reach out to your Brandywine relationship manager and take care.